Hey everyone, I figured today we would talk about tax loss harvesting, direct indexing. Unfortunately, when it comes to whether it's retirement planning, financial advising, financial planning, there's a lot of different terms out there that might make you feel like you're falling behind. So hopefully today we're going to cover what exactly is tax loss harvesting and direct indexing so you have a better idea. So with that, we're going to go to Steve. We're going to show you an example of what this looks like or what it might look like in your portfolio or in a portfolio that is using these strategies. One thing to note is that these strategies are only applicable for post-tax dollars. So everything that we're going to cover today would not work in your retirement account. So this is your individual TOD, your joint account with your spouse, really any post-tax account. Anything else, Steve?
No, I mean, you nailed it. Non-retirement accounts, that's really what it comes down to. And the key here too is why non-retirement accounts or post-tax accounts, there's a lot of different ways to say it, but why does it work for that account versus a retirement account? And really it's the way that post-tax accounts or these individual or joint brokerage accounts are taxed. Retirement accounts, they're tax deferred, and of course, depending on the type, whether it's a Roth IRA, we'll save that for another time. But retirement accounts are tax deferred, and of course, if it's an IRA, it's taxable upon distribution, taxed as ordinary income. Whereas post-tax accounts, brokerage accounts, even savings accounts, right, CDs, they are taxed every year in which you earn, whether it's interest or if you make a sale on a security within a brokerage account or with mutual funds. There's this term called phantom gains, right? So you're basically taxed on any activity that happens or anything that's realized or these phantom gains through mutual funds within a post-tax account. And so that's where the direct indexing or this tax loss harvesting using a direct indexing approach is extremely helpful in a sense because it can help you keep more money in your pocket. Right? At the end of the day, performance is great, but really it's the dollars that you keep, right? The after-tax performance, what goes in your pocket versus what goes to Uncle Sam. So right, Jeff. So that's kind of like one of the reasons why we're really excited to go through this because I think this tax loss harvesting, it gets thrown out a lot, right? We hear it all the time, and maybe some people understand it, maybe some people kind of understand it, but the one thing I think that helps, which we're going to kind of go through, is ultimately when you think tax loss harvesting, the key is this: you're looking to be as tax efficient as possible within that portfolio, right? So let's take the S&P 500, a widely known index, right? Tracks 500 of the largest US-based companies. A lot of these companies you're probably familiar with, but if you own, what's a good one? VOO, yep. Right? If you own an ETF, VOO, in a brokerage account, which we see all the time, you own the ETF. You own one ETF, but within that ETF, what happens, Jeff?
I mean, within that ETF, you're going to have some companies that are going to have large gains, and you're going to have some companies that are going to have mid gains, and some companies that might be at a loss, right? But at the end of the day, when you own that ETF, you own that blend. So you might see your ETF go up, by 5% or whatever it might be, but within that particular index, there's some companies that maybe, helped pull it to that point.
Exactly. Yeah, exactly. So you own one ETF, but within that ETF, there's, 500, let's just say 500 companies, and you can't control what stock within that ETF that you want to sell. Let's say if it's down or that maybe it's up and you want to sell, you can only sell the ETF. And so within that portfolio, holding these ETFs, a lot of times we see, it's really not as tax efficient as it could be. Yes, it's a good start, but it could be a little better by taking an approach where you own individual stocks, meaning you literally own each company. So again, taking the S&P 500, if we're tracking that, you would own the stocks within that S&P 500 or whatever index you decide or is best, right? That's really key. It's an index that you feel most comfortable with. And again, using the S&P 500, let's say there's 500 companies within that index. Maybe you own 150 to 200 of those companies. However, what we know now is that within every year, markets are volatile, right? I mean, yeah, the S&P 500 did well last year, but there was times during the year when some companies were down and when markets were down, right? That's the normal course of what markets do. They're volatile, short term. And so what is the portfolio that you have doing to take advantage of those downturns, of those market swings? Additionally, on top of that, how are you able to capture some of the losses so that you can start to harvest, right, tax loss harvesting, like harvest these losses so you can use for the future. And whether that's using to be able to manage the cost basis, right? So if you're selling companies for a loss, well, maybe you can sell a company for a gain, net it out. You reset that cost basis, you reinvest that money right away, and now you're in a situation where you're still tracking the performance, you're still invested, but now you might have maybe a realized gain. And at the end of the year, you could give that to your accountant, and while your account maybe is up 10%, you have a realized loss of whatever that amount is.
And that's a good point. So yeah, like the ETF or that index might be up 10%, and so if you're just in that ETF and you wanted to sell out, right, you said, hey, I need money, I want to pull money out. Well, if you're going to pull money out, right, you're going to create a taxable event, right, because again, your portfolio went up 10%. So you're creating this taxable event, and that's another thing that goes into the direct indexing or the tax loss harvesting is, we're going to show you an example here. Everyone's situation is different. Everyone's in different tax brackets, and so the higher tax bracket you're in, the more advantageous this becomes because you're able to get that liquidity out of your account. And to Steve's point, maybe, again, you sell out of one position and there's a gain, but you sell out of another position to create that loss so that there is, a net zero there from a tax perspective. We always talk about it's not what you make, it's what you keep. And this is a great way to show you how you can continue growing your portfolio, just like the index is doing, but allow you to, on paper, show a loss or harvest those losses for future years. So you want to dive into the example?
Yeah, and I think, to that point, it's the reporting, tax loss harvesting, and having the ability to do so is the first step. But I think what helps is having the ability to manage it and to kind of measure what exactly, or the benefit that you're receiving, which is why why we want to show you this report. We pull this report for our clients. I mean, I've done it in as little as 4 months when we have an account open, because it just helps gain a better understanding. We're talking about tax loss harvesting. We do it every day. Even talking about it right now, you still may have some questions. Seeing it, and this is what we're going to go through right now, and furthermore, even tracking it. So, every 6 months, every year, and then seeing the benefit at the end of the year when you get in those 1099s and you're giving them to your accountant, or maybe you're doing your own taxes, and you see, my account was up, but I'm able to have a loss and capture this loss in my tax return. Write it off ordinary income. There are some rules, we'll get there, and then carry forward that loss going forward. I think it's a really powerful thing. So let's do this, Jeff. Let's dive right into it. So what we see here, again, this is an example of a report for one of our clients. Obviously, names have been removed for confidentiality. But in this example here, you'll see, let me take this up. Okay, we are focusing on this on the Russell 3000. Remember, the index, whichever index you feel most comfortable with. And of course, I should say, right, Jeff, this is not done in a vacuum, right? And these tax strategies aren't done in a vacuum. This was part of an overall plan. So the reason, part of why we were tracking the Russell 3000 was because everything else that they were doing, everything fits within a puzzle. So I'll just kind of say that. But as you can see, we were looking at the Russell 3000. Within the Russell 3000, we are owning a portion of the companies within that index. Remember that, right? Because the key here is to be able to have the flexibility. If you sell 1 month, let's say, however many securities or companies, you want to make sure that you can buy. And there's certain rules, wash rules, we won't get into the details of it, but you have to be able to make sure you have a roster of companies to replace that company. And so that's why we're not owning the full companies within the index, only a portion. So in this case, you'll see here, the 1 year return, 18.51%. Now down below, the Russell 3000, you'll see 13.69%. The reason for the difference mainly is many times when we're looking at implementing a strategy like this, right, Jeff? It's like someone has had an account, they've held ETFs or they've held mutual funds, and there's a large gain, right? And so now, how do we unwind that? And so we don't do it all. We don't want to rip the Band-Aid all at once, typically, right?
Why would we not want to rip the Band-Aid all at once?
Great point. If it's a large gain, if you rip it all off, what happens?
Create huge taxable event, right? So if
Exactly.
if you own a bunch of mutual funds or ETFs, and in this situation, at one point you put in 500,000, and now it's worth 936,000, and you say, hey, Jeff and Steve, I want to do this tax loss harvesting, direct indexing approach. Well, if we just sold out of all of those holdings, you're going to get a huge 1099 for owning capital gains on roughly 400,000 plus, right? So what we'll do with our planning team is we'll let them know, hey, what our budget is from a capital gains perspective, so that it's not going to create all these other trickle-down effects from a tax perspective. So we'll go to our planning team and we'll say, hey, the most that we want to have on a capital gains budget is, I'm not sure if there's one on this situation, but here, 2003 capital gains budget, $1,000, right? So this particular client doesn't want to show anything on paper from a gain perspective, so nothing more than 1,000. So it's going to take us time to unwind that, right? Depending on what's happening within the portfolio. So like Steve mentioned, right? We're not going to go in and we're going to rip everything off and purchase every position within the Russell 3000. And so that's why you're going to see some discrepancies on the rate of return.
Exactly. So just so we could focus in, because we could go in a lot of different directions, right? But what we really want to focus in on the benefit here and how this report shows the benefit. So you see the pre-tax performance over here, right? And then you see the after-tax performance. Now the after-tax performance is just a reflection of what you are keeping, right? It's what you keep in the pocket. It's the amount that you are earning when we take into consideration the tax benefits. That's why you see here 11.66, a little higher than 8.73. So that tax alpha, right, the term, the jargon that we like to use, it's just above and beyond how much extra return are you getting by implementing this tax loss harvesting strategy. Right? Again, non-retirement account, we're able to leverage a tax-efficient portfolio, and so you'll see here, that's the number, the tax alpha of 3.35%.
Yeah. Again,
just kind of honing in on really the big pieces that we want to look at. In this case, they were in a 39% and 20% bracket. Now this was from a little bit ago, and because of different ways that they were being taxed, that was what we identified as the brackets.
And so real quick, Steve, so for example, if you own a CD, right, if this client owned a CD, they're in the 39% tax bracket, right? So if they own a CD, they're getting the interest right then and there, and again, they're making 4%, 5% on that CD. That CD is getting taxed at 39%. Same thing if they're doing any type of like day trading, they're in a 39% tax bracket for ordinary income, 20% for long-term capital gains.
All right, perfect. So what do we? So let's kind of dissect this. We have an unrealized gain here, right? Short term of 98,000, long term unrealized gain of 45,474, total of 143. Again, unrealized, right? So we haven't realized that. We haven't. We're not utilizing that for tax purposes, but we understand that it's still there. Where the rubber meets the road.
Real quick, Steve, going right back to that part. So again, when we're looking at this total portfolio, right, there's going to be different holdings within that portfolio that have, as you can see, grown. But then same thing with the unrealized loss, right? There's also positions in our portfolio that have a small amount of loss, right? So instead of looking at that ETF and seeing that, oh, it's up 10%, we're looking at our portfolio and we see that, hey, there's some positions that have done better and there's some positions that have done worse. Carry on.
Great point. Thank you, Jeff. Now, where the rubber meets the road. And this is the power of a tax loss harvesting strategy, is the net, I'm going to zoom in here, is the net realized gain loss, right here. Net realized gain loss. You'll see year to date, $31,039. So what is that saying? That means that they've realized a loss of $31,000.
On paper.
On paper, but wait a minute. They've earned 18.51. The value is $1 million. And so on paper, like Jeff said, at the end of the year, they're getting a 1099 that's showing a loss. Now, what do they get to do with that? Well, first off, if this client was married, so they're able to write off $3,000. $3,000 off of their ordinary income. So right off the bat, you're saving $3,000 off your ordinary income tax rate.
And if you're taxed at 39%, that's a good tax savings, right? So again, that's $3,000 less than you're paying 39% on.
And that's for whatever tax bracket that you
Correct,
ultimately-
yeah. So if you're in a 24%, it's all relative to
Yep.
what your numbers are.
And to that point too, Jeff, right? There's marginal brackets and there's effective rates, and so we won't get into the details there, but we try to get it as close to what you're actually paying. Right? So and sometimes that doesn't align with where the marginal rates are. But with that being said, now what happens if you write off the $3,000, 31,000 rough numbers minus 3,000, math pro.
Say it one more time. I was looking at
You wasn't even paying attention.
Well, not even paying attention.
31,000 minus 3,000.
31,000 minus 3,000, you're
Yes.
28,000.
28,000.
That you can carry forward.
Exactly. That you can carry forward indefinitely. Or coming back, if there's an opportunity, remember there's still $28,000 of losses, just we'll play this out. Well, this client had $45,000 of long-term unrealized gains. If there's an opportunity to maybe sell some of those gains, offset the loss, now we've just reset that basis, right? Because you sell it for a gain, the loss that we have harvested will offset that. We're reinvesting that money right away. And this is happening, right? Again, this is going on throughout the year. And the whole goal here is to be able to continue to reset cost basis, to harvest losses, to take tax advantages from being able to harvest those losses, whether it's through ordinary income or whether it's through netting out gains. And additionally, having the performance that you would have had if you held the ETF, right? If you held the VOO. A lot of times the question becomes, well, why not still just hold VOO? It's easier, it's simpler. Well, this is the exact same. I say VOO. VOO is a Vanguard index, ETF that tracks the S&P 500 index. So it could be anything, right? But at the end of the day, we're creating an ETF within this portfolio that's much more tax efficient, that's still getting the returns that the S&P 500 or whatever index would be getting, maybe sometimes slightly better. But when you add in the tax savings, the after-tax performance is typically going to be more than what you would have just received by holding an ETF, because you can't get those tax benefits from holding the ETF.
And the biggest thing here is also like the flexibility, right? So, again, if you're holding that ETF and it's growing, and then one year you want to pull it out, right? Well, yeah, you can sell out of that ETF, but it's going to create a taxable event, and maybe that taxable event now is going to affect how much taxes you pay on Social Security, how much you're going to be paying for your Medicare premium. So depending on your situation, right, there might be a lot of trickle-down effects from a tax perspective, but when you're doing it this way, you can control and say, hey, I need money, I need a liquid event, I need to pull X amount of dollars out, but with the flexibility, you can do so utilizing these losses so that you can pull out 30 grand, 50 grand, whatever that number is, out of your portfolio without it creating a taxable event. You can't do that if all your money is in ETFs and CDs, because if that ETF is growing, you can't cherry pick those individual positions that are at a loss or using the tax loss harvesting so that you're netting zero.
Exactly, yeah. And of course, right, these are the tools. And these tools are used they're to support the plan. It's not looking to kind of drive the decisions within it. It's to support what we've identified, like Jeff was kind of mentioning about everything else. But if when implemented properly, you could really definitely see more control, mitigate taxes, and still have the performance.
Yeah. And going back to the taxes and like the flexibility, for this individual, if they're maybe they're working, maybe they can't afford to have these capital gains or have this taxable event because their tax brackets are so high. But what happens if next year, for example, for whatever reason, they have a low income year, right? Maybe they're a business owner, maybe things are, well, that'd be a great year to now maybe, again, sell out of certain positions because their tax rates are lower. And so you can do these creative tax strategies in portfolios like this, where again, you're giving yourself more flexibility and more control over your portfolio.
Yeah, and I think that's the big one. And I can't stress the importance, I think, Jeff, you mentioned, and then we'll kind of wrap things up. But, obviously, if you have a portfolio like this each and every year, you're looking to mitigate taxes, you're looking to be as efficient as possible, reset basis, write off ordinary income. But, right, Jeff, going back to when you need to pull money out. There was an example, we had actually a client a couple years into retirement, really excited, and we had implemented a portfolio like this. And think about it, when you have an ETF, right, just to reiterate, when you sell that ETF, you can't control the taxes. If you need $100,000, you might have to pay tax on whatever gain that is. In this, with the client, when he pulled money, he needed $100,000. But what we were able to do, the losses that we were harvested, in addition to the current portfolio losses, because we can pick and choose what stocks to sell, he paid zero gain. And this, again, this doesn't always happen, right? But it just kind of illustrates the power behind having control, being able to be in a tax-efficient position so that you know more or less how much tax you'll be able to pay, and you can pick and choose what to sell so that you can limit those taxes.
Yeah. This strategy, it's a great strategy. The individuals that it may not be for, or for those that have shorter time horizons, they don't have a financial plan, right? Because again, we want to make sure that this, like Steve mentioned, is like a puzzle. It's working with everything else that you have going on, or individuals that are just getting out started. So if you only have, $50,000 to invest, that's where an ETF might be best. Because here we have to own certain positions, and so the minimum for, at least on our side, on the direct indexing, is 100,000, right?
That's correct.
But again, once you get to that 100,000, and again, this is non-qualified accounts, right? So non-retirement accounts. But yeah, just wanted to put that out there.
Yeah.
So this is, again, we can work with this. You don't have to have $1 million. We just need to have at least roughly 100,000. Maybe down the road that comes down. But from our planning team's perspective, obviously we need enough capital to be able to go in out of those different, stock positions.
Yeah, exactly. And again, we can't stress the importance that while we're talking about investments right now, it's not about just one portfolio. It's not about one type of investments. It's about the plan.
Yeah, these strategies do not replace planning.
Exactly.
You need a plan.
Exactly.
Yeah. What else? One thing I wanted to talk about, because we're talking about losses, and we're like, Jeff, Steve, why would I do this if you're talking about losses? Well, again, remember, within that ETF, within that index that you're following, right, there's going to be times where Apple is up and Coca-Cola is down. And so if Coca-Cola is down from when we bought in, again, that's where if we sell out of Coca-Cola, we create that paper loss, and then maybe we're buying into Pepsi or a similar position, again, avoiding wash-sell rules and things like that. So again, your portfolio from a whole is going up, but I know when we're saying losses, I'm hoping that's not triggering anybody, right? But again, within that portfolio that you're holding, whether it's the S&P 500, the Russell, within all those different holdings, there's some companies that have gone up, some companies that have gone down, and all we're doing is we're mixing and matching to make sure that we're doing a great job from a tax perspective, right, while following that index.
Yeah, and just lastly on this report, as everyone can see here, there's a lot of other numbers here. We just wanted to be as efficient as possible going through this with you. We certainly, if anyone wants to take a deeper dive, we can certainly go through it in more detail, but we just wanted to get the concept right across of why it's important and why having a reporting mechanism where we can show the value and the benefit helps kind of further the understanding. So when you see it, now you can see, okay, here's the growth, here's the realized taxes, and here's the unrealized. I think it just all comes together.
Yeah. Everyone's going to have different tax brackets. Everyone's going to have different, investments, right? So again, obviously if you're coming to us with X amount of dollars in cash, it's a lot easier to kind of get going. But a lot of times clients will come to us with, money in their brokerage account at Fidelity or Merrill Lynch, wherever it might be, and there's a gain there. So depending on what their tolerance is for having capital gains, right, what their budget is, Everyone's situation is going to be different, also depending on what type of portfolio. Maybe they want a dividend-producing portfolio. Maybe they want a blue chip portfolio, Russell 3000, S&P 500. So there's so many different ways that this can go. Again, hopefully this kind of illustrates, what tax loss harvesting is and direct indexing and how, it could benefit, you and your plan.
Yeah, absolutely. I think that's about it. Wraps it up, right?
Yeah, it wraps it up. If you have any questions on tax loss harvesting, reach out to our team, and we'd love to kind of talk to you about it. Otherwise, until next time.
Go do that thing.